right now, you probably think your money is sitting in a steel vault.
Right, like some big physical safe.
Exactly. We all have this deeply ingrained, almost comforting image of what a bank is. You walk in, you see the polished marble floors, the neat stacks of $100 bills behind bulletproof glass, and you imagine a massive, impenetrable steel door.
Yeah, it implies physical control, right?
Yeah.
Like safe or not safe,
Yeah.
clean and binary.
Exactly. But here is the jarring reality. That vault is basically an illusion. Step into the actual modern world of global finance, and that steel door just evaporates entirely.
Oh, completely.
Your money isn't sitting in a room. It is currently broken into 1,000 digital pieces, woven into this incredibly dense, invisible web of global liabilities, just floating through a shadow system that at one point was worth $22 trillion.
It is the ultimate muddy water. The gap between how the average person visualizes their savings and, the staggering mathematical complexity of what is actually happening to that money overnight, it's immense.
Which is exactly why we are here. Welcome to this deep dive. Today, we are opening up the absolute master text used by central bankers, regulators, and academics to understand this invisible machinery.
And it is a dense one.
Oh, it's an incredibly dense, scholarly behemoth. I'm talking about the Oxford Handbook of Banking, 3rd edition. We're going to completely deconstruct this academic brick today.
Yeah, we're taking all of its deeply researched parts and theories and translating them into a genuine masterclass on modern banking for you.
Right, we want to figure out how the global financial architecture actually functions a full decade after the global financial crisis.
Yeah.
And we're doing it entirely without the impenetrable Wall Street jargon.
And to really ground this for you, we have to recognize the landscape first. The banking industry today is operating with a massive systemic hangover.
A 10-year hangover, basically.
Exactly. The wild, highly liberalized, high-flying environment of the early 2000s is completely dead. Today, regulators are forcing banks into a long-term process of de-risking. They are mandated to hold vastly more capital.
Right, making them play it safe.
But at the exact same time, their traditional profit engines are under siege. You have fintech innovations stripping away their payment revenues, peer-to-peer lending, bypassing them completely.
And obviously the crypto threat.
Yeah, the looming existential threat of over 2,000 different cryptocurrencies, with Bitcoin holding, a dominant 54% market share, and they're all promising to make the traditional banking middleman obsolete entirely.
It's a vice grip. Regulators are squeezing them from the top, and tech innovators are chewing at their ankles from the bottom. Okay, let's unpack this.
Where do we start?
Well, before we get into the crypto threats, or how massive megabanks collapse, or how the shadow system works, we have to rip everything down to the absolute studs.
The basic theory.
Right? Why does this complex machinery even exist in the first place? If you look at the fundamental theory of the text, it all comes down to solving a very basic human problem, which is friction.
That is the core of it, yeah. The literature points to two massive economic fictions that justify the existence of banks: information asymmetry and intertemporal risk smoothing.
Okay, let's take those one at a time.
Sure. So information asymmetry is just the reality that in any transaction, one party knows significantly more than the other.
Let me see if I can ground this for a second. Imagine you, the listener, have managed to save up $10,000. You want to earn a return on it.
Okay. Fairly standard situation.
Right. Now, across town, there's a baker who desperately needs $10,000 for a new industrial oven. In a frictionless utopia, you would just drive over and hand the baker your cash.
But you don't do that.
No, of course not. Why? Because you have no idea if this baker is actually any good at selling bread.
Exactly. You suffer from a profound lack of information. And the literature highlights that this lack of information creates two distinct fatal problems for the economy.
The first one being?
The first is adverse selection. This happens before you even make the loan. In a world without banks, the only people desperately knocking on your door asking for your $10,000 are the riskiest borrowers.
Because the good ones don't need my money.
Right. The ones who can't get money anywhere else are the ones begging strangers for cash. Safe, reliable businesses don't do that. So the pool of potential borrowers you interact with is adversely selected to be highly risky.
So, just by participating in this direct lending, I'm already swimming with sharks.
Pretty much. And then comes the second problem, which is moral hazard. This happens after you hand over the money. Let's say you take a leap of faith and lend the baker the $10,000.
Okay, fingers crossed.
Suddenly, the baker's incentives change. because it's your money on the line, not theirs, they might decide to take wild, reckless gambles.
Like what?
Well, they might try to expand into selling highly perishable gourmet pastries that they know absolutely nothing about. If the gamble pays off, they keep the massive profits. If the pastries rot, they just default, and you lose your $10,000.
Wow. Man, I certainly don't have the time, the accounting skills, or, the legal resources to audit a bakery's books every week to stop them from doing that.
Which is exactly why the bank exists. The text describes banks as delegated monitors.
Delegated monitors. I like that phrase.
Yeah, you, the saver, delegate the intensely difficult job of screening for adverse selection and monitoring for moral hazard to the bank.
Because they have the resources.
Exactly. The bank possesses the economies of scale, the historical data, and the specialized expertise to underwrite that baker efficiently.
Okay, that makes total sense on a local level. But what's fascinating in the text is how different regions of the world rely on these delegated monitors.
Yeah, the geographic split is huge.
It really is.
Yeah.
The data they provide shows a massive global split. If you look at the corporate funding structure in the United States, it is incredibly market-based.
Right.
Huge corporations in the U.S. often bypass traditional banks completely and get their funding directly from financial markets, by issuing bonds or equities to investors.
But if you cross the ocean to the Euro area or Japan, the architecture is vastly more bank-reliant. The traditional bank loan remains the absolute lifeblood of corporate funding over there.
The divergence is stark, but the literature documents a very dangerous evolution that began accelerating in the late 20th century, right?
Yeah, despite these regional differences, traditional commercial banking and the fast-paced financial markets began to aggressively bleed into one another.
They started mixing.
Heavily. The textbook boundary between a bank, which takes deposits and makes loans, and the capital markets, which trade securities, completely dissolved. Banks started relying heavily on the markets not just for raising their own capital, but for generating fee revenue and managing their internal risks.
Wait, let's back up here. I see the logic of using markets to raise capital, sure. But why would a traditional bank, whose whole job is to safely monitor local bakeries, need to intertwine itself with volatile global financial markets to manage risk?
It seems counterintuitive, right?
Doesn't that invite the chaos of the trading floor right into the vault?
What's fascinating here is, to understand why they did it, we have to look at the real magic trick of banking. It's a concept the text calls qualitative asset transformation.
Qualitative asset transformation. Break that down for me.
Think about the bank's balance sheet. When you deposit your $10,000, that is a liability for the bank. They owe you that money. And it is highly liquid, meaning you can demand it back tomorrow morning.
Right, and it's also supposedly riskless. I expect all 10,000 back, no questions asked.
Exactly. But look at what the bank does with it. They take your liquid, riskless deposit and transform it into a loan for the bakery.
Which is the opposite of liquid and riskless.
Exactly. That bakery loan is deeply illiquid. It's tied up in an oven for 10 years. And it is risky because the bakery could easily go bankrupt. They are taking something short-term and safe and turning it into something long-term and risky.
So that transformation is the essential economic value a bank actually provides.
Yes.
But mathematically, that means they're sitting on a massive, terrifying mismatch every single day.
A huge mismatch.
If I and, all the other depositors show up on Tuesday demanding our cash back, the bank can't just go rip the oven out of the bakery to pay us.
Exactly the problem. Qualitative asset transformation is inherently systemically dangerous. So, as banks grew larger, they looked to the sophisticated financial markets to hedge that danger.
How did that work?
They thought, if we can use complex financial derivatives and market instruments to sell off pieces of the interest rate risk or the default risk of these bakery loans, we can make our balance sheet bulletproof.
But that's the great paradox the text points out, isn't it? By tying themselves so intimately to the global markets to hedge their local risks, they didn't actually eliminate the danger.
Not at all.
They just weaponized it. An idiosyncratic shock in an obscure market suddenly became a shock to the entire global banking system.
The integration created a new, highly contagious systemic vulnerability. The safety mechanism itself became the conductor for the contagion.
Which pivots us perfectly into the reality of what these institutions actually look like today. Because if the theoretical textbook model is just a helpful delegated monitor doing qualitative asset transformation, the physical reality of modern corporate banking is a completely different universe.
It's unrecognizable.
I want to look at the sheer Frankenstein-level complexity of these entities.
The data on corporate complexity provided in the handbook is genuinely staggering. They analyze what are known as GSIBs.
Global, systemically important banks.
Right. These are the absolute titans of the financial world, the institutions whose failure would threaten the global economy.
And the numbers are just mind-boggling. When they looked at the legal structures of these GSIBs, the median number of controlled subsidiaries for a single global bank was 923.
And that's just the median.
Yeah. The text notes that one particular megabank had a high of 2,435 separate controlled subsidiaries.
It's a massive web.
I have to push back on this. Why on earth does a single bank need over 2,000 separate legal entities? To the average person, that looks exactly like a giant Russian nesting doll designed intentionally to hide toxic assets from the government.
I mean, it is very easy to assume malicious intent.
Is it just a massive scam?
Well, certainly some opacity is exploited, but the literature unpacks the necessity of this complexity. A lot of it is driven by the friction of operating a global business in a fractured regulatory world.
So it's about borders.
Largely, yes. These banks operate across dozens, sometimes hundreds, of national borders. Every single country has its own distinct tax laws, its own minimum capital requirements, and its own regulatory regime.
So they have to adapt to each one.
Exactly. To legally operate a branch in Tokyo, a bank based in New York often has to spin up a distinct, legally ring-fenced local subsidiary.
So it's basically a giant patchwork quilt of regulatory compliance?
Furthermore, modern banks are not just making loans anymore. They are involved in wildly diverse activities. Insurance underwriting, asset management, high-frequency trading, real estate.
They do everything.
And by law, many jurisdictions require these fundamentally different activities to be housed in separate legal entities to prevent the risks from cross-contaminating.
Okay, I understand the legal necessity of that, but the text points out a terrifying consequence of this structure. What actually happens when the music stops?
You hit on the ultimate nightmare for central bankers, which is resolution.
Resolution, meaning when a bank goes under.
Right. When a normal company goes bankrupt, the process is domestic and relatively straightforward. The courts liquidate the assets and pay the creditors.
But with a GSIB,
But imagine trying to resolve a GSIB with 2,435 subsidiaries spanning 50 different sovereign nations. And you have to do it over a single weekend to prevent a global panic on Monday morning.
it sounds totally impossible. Who even takes the losses in that scenario?
That is the chaotic reality. The complexity crosses international borders, but bankruptcy laws and resolution mechanisms are strictly domestic.
Oh, so they clash.
Exactly. If a London subsidiary of a U.S. bank holds the toxic assets, but the New York parent company holds the capital, which country's taxpayers are on the hook?
Good luck figuring that out in 48 hours.
Exactly. How do you legally disentangle the shared IT systems, the derivative contracts, and the collateral over a weekend? The structure makes safe resolution nearly impossible.
It sounds like a machine so vast that the CEO sitting in the penthouse couldn't possibly know what the trader in the basement of subsidiary number 1,400 is actually doing.
They absolutely can't.
Which brings up a critical question explored in the text regarding corporate governance. If the structure is a massive Russian nesting doll who is actually accountable,
Governance is key here.
the handbook brings in this classic economic theory by Jensen and Meckling about agency costs. Let's dig into that.
Agency theory is essential for understanding bank behavior. An agency cost arises whenever the person managing the money, the CEO, the corporate insider, has fundamentally different financial incentives than the people who actually provided the money.
Okay, makes sense.
In a corporate bank, you don't just have two parties, though. You have a three-way war of incentives between the corporate insiders, the shareholders, and the creditors.
And the creditors include the everyday depositors like you and me and the people who buy the bank's bonds, right?
Correct. Let's look at the shareholders first. Shareholders hold what is called the residual claim on the bank's assets.
Residual claim, meaning what?
In plain English, this means if the bank goes bankrupt, the shareholders are at the absolute back of the line. They get wiped out to zero.
Okay.
However, if the bank takes a massive, highly leveraged gamble that pays off, the shareholders reap almost 100% of that upside.
So it's the ultimate asymmetric bet. Heads, I win $1 billion. Tails, you lose everything.
Precisely the dynamic. Shareholders mathematically benefit from high volatility and high risk. But the creditors, your everyday depositor or a pension fund holding a bank bond, have the exact opposite incentive.
Because they don't get the upside.
Exactly. If the bank makes $1 billion on a risky trade, the creditor doesn't get a dime of that extra profit. They just get their fixed 3% interest rate.
But if the risky trade blows up the bank, the creditor's savings are vaporized.
Exactly. So creditors demand extreme conservatism and safety.
And the catastrophic flaw, as the text highlights, was how we decided to pay the corporate insiders, the CEOs. For decades, the dominant business mantra was, align the CEO's interests with the shareholders.
Oh, it was taught in every business school. The idea was to prevent CEOs from getting lazy. So boards of directors started compensating bank CEOs almost entirely with massive equity grants, stock options, and bonuses tied to the quarterly share price.
But wait, if you align the CEO with the shareholder, and the shareholder mathematically wants maximum risk, you've just handed the keys to a race car to someone who gets paid based on how close they can drive to the edge of the cliff.
You perfectly incentivized massive risk-taking. By tying compensation to equity, we mathematically told the CEOs to ignore the safety of the creditors and just swing for the fences.
And it worked for a while.
Right. The shareholders enjoyed the massive upside during the boom years of the early 2000s. But when the risky bets collapsed during the GFC, the shareholders were wiped out, and the creditors and ultimately the taxpayers who had to bail out the system bore the massive downside.
That seems like a fatal flaw in the architecture. You can't just ask a CEO nicely to stop taking risks if their multi-million-dollar paycheck depends on it.
Incentives drive behavior.
So how does the literature suggest we actually fix this?
The text introduces a brilliant counterintuitive solution from the recent governance literature. It's the concept of inside debt.
Inside debt. Okay, I need to understand the mechanics of this. How does that work?
Well, if paying a CEO in equity aligns them with the risk-loving shareholders, how do we align them with the risk-averse creditor?
We pay them in debt.
Exactly. We pay them in debt. Inside debt refers to compensating bank executives with debt-like instruments. The most prominent example being massive, unsecured deferred pensions or deferred compensation plans.
Ah, so they earn the money now, but it sits inside the bank and they can't actually touch it until years after they retire.
That's the mechanism. If a CEO has a $20 million unsecured deferred pension sitting on the bank's balance sheet, that CEO essentially becomes a giant unsecured creditor to their own bank.
Oh, wow.
So if they take a wild gamble and blow up the bank, the equity gets wiped out, but so does their retirement fund. They become an unsecured creditor in bankruptcy court, just like everyone else.
That is fascinating. It basically uses their own psychological self-interest as a brake pedal.
And the empirical evidence cited in the text strongly supports this. CEOs with large holdings of inside debt become vastly more conservative.
Because their own neck is on the line.
Right. They're significantly less likely to engage in wild trading strategies, over-leveraged acquisitions, or subprime lending because their personal downside is severely exposed. The structural incentives change their behavior entirely.
That is a brilliant boon of behavioral engineering. But if inside debt is the brake pedal that slows the bank down, we need to understand how the engine actually generates forward momentum.
The liquidity creation side.
Exactly. How do these massive entities actually create liquidity on a daily basis? This takes us into a profound historical shift in bank performance and liquidity creation that the handbook covers.
Yeah, the synthesis of the literature on liquidity creation charts a fundamental pivot in the plumbing of global finance. It is the shift from the traditional originate-to-hold model to the modern originate-to-distribute model.
Okay, let's break these down. Originate to hold, or OTH. This is a classic Jimmy Stewart, It's a Wonderful Life model of banking, right?
That's the one.
The local bank originates a 30-year mortgage for the Bailey family, and the bank holds that exact mortgage on its own books for the entire 30 years.
Right. And in that model, the bank has ultimate skin in the game. Because they are locking up their capital for 3 decades, they are fiercely incentivized to rigorously screen the borrower up front and monitor their financial health continuously.
It fosters deep, long-term relationship lending.
Exactly. But the text notes a massive shift toward originate to distribute, or OTD.
And how does OTD differ?
The OTD model fundamentally alters the bank's role. Instead of acting as a vault that holds loans, the bank begins to act like a manufacturing assembly line.
A factory.
Right. They originate the mortgage, but they have absolutely no intention of holding it on their balance sheet. Instead, they immediately package that mortgage together with thousands of others and sell it off to the global financial markets as a securitized product.
I want to try an analogy here to see if I truly grasp the danger of this. The OTD model feels like a restaurant where the chef knows he will never, ever have to eat his own cooking.
Oh, that's good.
And he's also paid off the health inspector. He's just churning out food as fast as possible to sell to people out the back door. If I am the bank, and I know I am selling this mortgage to a pension fund in Norway tomorrow afternoon, why do I care if the borrower defaults in 3 years?
You don't.
My incentive to ensure the loan is actually good drops to zero.
That analogy captures the exact moral hazard at the heart of the subprime mortgage crisis. The OTD model completely severed the incentive to screen borrowers.
It led to those notorious ninja loans, right?
Exactly. Ninja loans, no income, no job, no assets, because the originator was paid a fee for the volume of loans produced, with zero penalty for the long-term quality. However, the academic literature is nuanced here. OTD isn't inherently evil.
Wait, how can it not be? It literally caused a global meltdown.
Because prior to the meltdown, OTD allowed for a massive, historically unprecedented expansion of global credit and liquidity. By moving loans off their balance sheets, banks freed up capital to lend again immediately.
So more people could buy homes.
Right, it democratized access to credit for millions of people and fueled immense economic growth. The ongoing policy challenge today is not to ban OTD, but to mandate that originators retain a specific percentage of the risk.
Forcing them to keep some skin in the game.
Exactly. So the chef is forced to eat at least one bite of every meal he cooks.
I love that. And this massive engine of liquidity creation brings us to one of the most fiercely debated topics in the text, the scale of these institutions.
The too big to fail debate.
Right. Are these global megabanks simply too big to be efficient?
This is a debate with profound, immediate policy implications. For decades, the traditional economic literature analyzed bank efficiency and concluded that economies of scale, the idea that getting bigger makes your per-unit costs lower, tempered off very quickly.
Oh, really?
Yeah. The old models argued that once a bank reached a moderate regional size, growing into a trillion-dollar megabank didn't actually make them any more efficient at producing loans.
Which gave politicians massive ammunition. They could stand at a podium and say, look, these giant banks are a systemic threat, they are too big to fail, and the academic math proves they aren't even economically efficient. We should shatter them into 1,000 pieces.
But the newer literature presents a massive counter-argument. They point out a fatal flaw in those older efficiency models.
Which was?
The old models completely failed to account for risk.
Ah. Let me refine my earlier race car analogy then. Judging a massive bank's efficiency solely by looking at its operating costs, without factoring in its risk profile, is like judging a race car's performance solely by its top speed on a straight track, while ignoring its aerodynamics and its braking system.
That's spot on.
Sure, a smaller car might hit the same top speed, but the massive engineered race car can take a hairpin turn in the rain without flipping over. You have to measure the output and the survival mechanisms together.
That is an excellent refinement. When economists rebuilt the models to properly integrate risk, specifically analyzing how a massive scale allows a GSIB to geographically diversify its loan portfolio, access vastly cheaper funding markets, and deploy billion-dollar risk management software that a small bank could never afford, the results completely flipped.
Really?
Yes. When risk is accurately modeled, large banks do possess significant ongoing scale economies. They are highly efficient at processing complex, informationally intensive assets.
So this traps policymakers in an agonizing dilemma.
A brutal one. If regulators bow to political pressure and forcibly break up the large GSIBs to solve the too-big-to-fail problem, they might actively destroy immense economic efficiency.
Like, might not even work.
Even worse, yeah.
Right.
The literature warns that capping the size of domestic regulated banks won't actually destroy the demand for those complex global financial services. It will simply push those activities offshore to less regulated countries or force them into the dark, unregulated shadow banking sector.
So you don't eliminate the systemic risk at all.
No, you just blindfold yourself to it.
Wow. So trying to make the system safer by smashing the big banks could actually decrease efficiency and push the danger into the shadows. Talk about an unintended consequence.
A classic regulatory trap.
But to be totally comprehensive here, we have focused heavily on the GSIBs, the apex predators of the financial ecosystem. The text makes it clear that the global financial system is not a monolith.
Not at all.
There are entirely different genetic models of banking operating right now, serving completely different societal needs. Let's look at this tapestry of alternative models.
This is a vital pivot. While the G-SIBs are trading complex derivatives in London and New York, the literature extensively covers institutions whose underlying DNA is fundamentally different.
Give me an example.
Take community banking institutions, credit unions, cooperative banks, and local savings banks. Their entire survival strategy is predicated on something global banks struggle with, which is relationship lending.
And they actually weathered the financial crisis remarkably well in many regions, right? Why is that?
It comes back to the agency costs and corporate governance we discussed earlier. Cooperative banks and credit unions have a unique organizational structure. They are owned by their depositors, their members, not by distant Wall Street shareholders.
Oh, so the people providing the money and the people holding the residual claim are the exact same people.
Exactly the point. This fundamentally alters their risk appetite. The management isn't chasing short-term quarterly profit spikes to juice their equity bonuses. They are optimizing for the long-term stability and service of the local community.
So it's a completely different incentive structure that naturally dampens reckless risk-taking.
Precisely.
And speaking of different fundamental rules, the text dedicates significant analysis to Islamic banking. This is a rapidly growing sector of global finance, and it operates on a foundational rule that seems completely alien to Western finance.
It requires a total paradigm shift to understand. Islamic banking must strictly adhere to Sharia law, and the most profound non-negotiable difference from conventional banking is the absolute prohibition of riba, which is the charging or paying of fixed interest.
I really need you to walk me through the mechanics of this. The entire concept of a bank is renting out money for a fee. How does an Islamic bank possibly generate revenue if it is legally forbidden from charging interest on a loan?
Instead of a traditional debt contract where the borrower owes a fixed interest rate regardless of what happens, Islamic banking relies heavily on profit and loss sharing agreements, primarily known as mudoraba and musharaka.
Mudaraba and musharaka. How do those actually work in practice?
Let's go back to our baker. If an Islamic bank finances the baker's new oven under a musharaka agreement, they are not making a loan. They are essentially taking an equity-like joint venture stake in that specific project.
Okay.
If the baker sells a ton of bread and the project makes a profit, the bank and the baker share that profit based on a pre-agreed mathematical ratio.
Okay, but what if the baker's oven breaks and the business takes a loss?
Then the bank shares in that financial loss. The capital provider assumes the actual risk of the enterprise. The bank is a true economic partner, not just a detached senior creditor waiting for a guaranteed monthly check.
That changes the entire psychology of the transaction.
It does. And the empirical literature in the handbook shows this has fascinating implications for systemic risk. Because the Islamic bank directly shares in the losses, they have a massive, unavoidable incentive to monitor the projects closely.
So they can't just originate and distribute.
Right. Furthermore, some studies suggest this structure makes Islamic banks inherently more resilient during massive financial panics.
Why is that?
Because their balance sheet assets and liabilities are organically, intrinsically linked to the actual performance of the real physical economy. They aren't holding massive portfolios of synthetic leveraged interest rate derivatives that can explode overnight.
It grounds the financial system in physical reality.
Ah.
That's incredible. Now, moving from the Middle East to developing economies globally, the text delves deeply into microfinance.
Yes, a totally different model again.
Historically, this was hailed as the absolute miracle cure for global poverty. The idea was simple. Give tiny microloans to entrepreneurs in impoverished regions who possess absolutely zero collateral.
But without collateral and without any hard credit data, how do you solve the massive information asymmetry?
Right. How do you know they'll pay it back?
The historical genius of microfinance was an innovation called joint liability or group lending.
Here's where it gets really interesting. Let me see if I grasp the brilliant sociology of this.
Go for it.
If a massive global bank wants to figure out if you are risky, they run your data through supercomputers and algorithms. But a microfinance institution operating in a rural village doesn't have algorithms. So they weaponize human gossip and village peer pressure.
That is a highly accurate way to describe the mechanism. Under joint liability, the microfinance institution doesn't lend to an individual. They lend to a self-formed group of, say, 5 women in a village.
Okay.
If one woman in the group defaults on her portion of the loan, the other 4 women are legally cut off from any future credit until the debt is made whole.
Which creates an immense incentive for the group to police itself.
Exactly. Because these women live in the same village, they know intimately who is a hard worker, who drinks too much, and whose business idea is terrible. They possess the vital soft information that the distant bank lacks.
So they gatekeep the group.
Yes, therefore, they self-select their groups extremely carefully, rejecting the risky individuals. And the social peer pressure to repay the loan is immense. The bank effectively outsourced the costs of screening and monitoring to the social fabric of the village itself.
But the literature notes a significant and somewhat controversial shift happening in microfinance today, right?
Yes, the handbook documents a massive industry shift away from joint liability toward individual lending. This is being driven by a powerful trend of commercialization.
They're trying to act like regular banks.
Precisely. As microfinance institutions try to scale up globally and attract massive institutional capital, they are starting to act much more like traditional commercial banks. They are relying on credit scoring technologies rather than village peer pressure.
But doesn't that commercialization destroy the original mission?
That is the intense debate in the literature. Does prioritizing financial sustainability and profit margins dilute the social impact? Are these commercialized microfinance banks moving away from the poorest, most vulnerable borrowers and drifting toward slightly wealthier clients who can handle individual liability?
It is the classic tension between a social mission and a scalable business model.
It really is.
And that concept of soft information you mentioned with the village gossip is a perfect bridge to how small businesses get funded everywhere. The text makes a really sharp distinction between hard information and soft information.
This distinction is the absolute bedrock of small business lending. Hard information is strictly quantitative.
Numbers, basically.
Right. It is a FICO credit score, an audited tax return, a standardized collateral appraisal. Hard information is highly transmissible. It can be easily digitized, emailed across the globe, and processed by a risk algorithm at a GSIB in New York in milliseconds.
But soft information is entirely qualitative and deeply human.
Yes. Soft information is the local loan officer, knowing that the restaurant owner works 80 hours a week, has immaculate character, and that the entire town lines up for their food on Fridays.
Even if the paper numbers look bad.
Exactly. Even if the restaurant's tax return from last year looks artificially weak because of a one-time cash purchase of a refrigerator.
You can't put immaculate character into an Excel spreadsheet.
Precisely why soft information is notoriously difficult to digitize or pass up a massive corporate hierarchy. A junior loan officer can't easily convince a risk committee in another country to approve a loan based on good character.
They just laugh him out of the room.
Which is why the literature consistently shows that small, local community banks historically possess a massive comparative advantage in soft information lending, while the giant GSIBs dominate hard information lending.
So bringing this entire tapestry together, from the algorithmic megabanks to the Sharia-compliant profit sharing, to the peer pressure village microfinance, to the local community banker relying on soft info.
It's all connected.
It is. When you strip away the wildly different cultural and technological wrappers, they are all just diverse human inventions designed to solve the exact same foundational friction: the information gap between someone with capital and someone who needs it.
That is the unifying thread of the entire global system.
It's a beautiful system, in theory.
Mm.
But we have to address the dark matter of the financial universe.
The shadows.
Right. If traditional banks, whether they are tiny community lenders or heavily regulated GSIBs, are under the microscope of regulators, where did all the incredibly toxic risk actually hide leading up to the massive crises? We have to step out of the regulated light and into the shadows. Let's examine the mechanics of securitization and the shadow banking system.
We touched briefly on the originate to distribute model earlier, but to understand the shadows, we must drill into the literal mathematical mechanics of securitization.
The alchemy of finance.
This is the alchemy of modern finance. It is the complex legal and financial process where thousands of illiquid, risky assets like individual subprime mortgages, auto loans, or credit card debts are pooled together and repackaged into highly liquid, interest-bearing securities that can be sold to global investors.
It sounds like taking thousands of separate melting ice cubes and throwing them into a blender to create a massive flowing river of liquid cash. But how did throwing a bunch of risky subprime mortgages into a blender make them safe?
Right. Why wouldn't the smoothie be toxic?
Exactly. If they were toxic individually, shouldn't the blended smoothie be toxic too?
That is where the engineering of tranching comes in. This is crucial to understand. When they pool these thousands of mortgages together, they don't just sell equal slices of the pie. They slice the pool horizontally into risk categories called tranches.
Okay, lay out the tranches for me.
You have the senior tranche at the top, the mezzanine tranche in the middle, and the equity tranche at the very bottom.
Okay, explain the waterfall mechanism of how these tranches absorb losses.
Imagine the monthly mortgage payments from all those homeowners flowing into this structure like a waterfall. The water hits the senior tranche first. They get paid absolutely first.
So they're the safest.
Right. Once they are fully paid, the remaining water flows down to the mezzanine tranche, and finally, whatever is left trickles down to the equity tranche at the bottom.
And what happens when people start defaulting on their mortgages and the waterfall dries up?
Losses hit from the bottom up. The equity tranche takes the very first dollar of loss. The senior tranche doesn't lose a single penny until the equity and mezzanine tranches are completely 100% wiped out.
Ah, so the guys at the bottom act as a massive shock absorber for the guys at the top.
Exactly. Because of this structural protection, the credit rating agencies looked at the senior tranches of these subprime pools and stamped them with a pristine AAA rating. They mathematically engineered the illusion of absolute safety out of underlying sludge.
And this securitization alchemy was the pulsing lifeblood of what the literature defines as the shadow banking system. I want to talk about the sheer terrifying scale of this.
The authors define shadow banking formally as non-bank credit intermediation.
Non-bank credit intermediation.
Yes. These are entities like money market mutual funds, massive hedge funds, structured investment vehicles, and specialized finance companies. They look like banks, they act like banks, but they operate entirely outside the traditional, heavily regulated banking system.
And the size is just staggering.
The data shows that the shadow banking system in the U.S. peaked at an estimated $22 trillion just before the crisis.
$22 trillion. That was significantly larger than the entire traditional regulated banking system at the time.
Mm-hmm.
How did so much money migrate into the shadows without regulators stopping it?
The literature identifies several powerful drivers. Specialization was one. Different shadow entities became hyper-efficient at specific, narrow steps in the securitization chain.
What else?
Financial innovation was another. Global investors had a massive appetite for AAA-rated, safe assets, and the shadow system manufactured them. But the most critical driver was regulatory arbitrage.
Regulatory arbitrage. Let me try a visual analogy here to explain that.
Let's hear it.
Imagine the global financial system is a massive, slightly underinflated balloon. The regulators come in and see the traditional banks are taking too much risk. So they squeeze the traditional banking side of the balloon incredibly hard.
Adding rules, capital limits.
Exactly. They demand higher capital requirements, strict stress tests, and massive compliance audits. But the air inside the balloon, the fundamental economic demand for leverage and high-yield credit, doesn't just disappear.
It has to go somewhere.
Right. If you squeeze one side, the air just violently shifts and expands the unregulated and visible side of the balloon. The risk doesn't vanish, it just mutates and moves into the shadow banking sector, where regulators can't even see it.
That is the exact dynamic of regulatory arbitrage. The banks actively set up these off-balance sheet shadow entities to bypass the capital requirements regulators were imposing on them.
Wow.
But here is the fatal flaw, the reason it all collapsed. The shadow banking system was performing the exact same qualitative asset transformation as traditional banks.
Meaning they were taking short-term liquid funds and locking them up in long-term illiquid assets.
Precisely.
Yeah.
Take a money market mutual fund. Investors treated them like bank accounts. They could withdraw their cash every single day. The fund took that liquid cash and used it to buy commercial paper, which funded the long-term illiquid securitized mortgages.
It was the exact same maturity mismatch, the exact same inherent danger we discussed back at the start.
But there is one catastrophic difference. The shadow banks were doing this high-wire act entirely without a safety net.
That is the fatal difference. Traditional banks have deposit insurance to prevent depositors from panicking, and they have the central bank as a lender of last resort to provide emergency cash if a run happens.
The shadow banking entities had neither. No government insurance, no central bank vault. This made them uniquely, systemically fragile to run like panics.
So the moment the underlying housing market wobbled and investors realized the AAA ratings were a mathematical illusion, they realized there was no safety net to catch them.
And they all ran for the exits simultaneously. It was a classic bank run, but on a $22 trillion scale. And because the traditional banks were deeply intertwined with these shadow entities, they had provided them with backup lines of credit to get them started, the panic violently infected the regulated system.
It's like the shadow collapsing and dragging down the object that cast it,
Yeah.
which forces us to look at what happens when the free market completely paralyzes. When the shadow system and the traditional system are both in free fall, the referees must step onto the field.
The central banks.
Right. We have to examine the immense, impossible role of central banks and regulators.
The text provides a deep dive into the science of central banking. It outlines the core principles guiding institutions like the Federal Reserve or the European Central Bank.
What kind of principles?
Principles such as inflation is ultimately a monetary phenomenon, managing the public's psychological expectations is just as important as adjusting interest rates, and the absolute necessity of central bank independence from short-term political pressure.
But the literature also highlights a massive, terrifying constraint central banks hit during the crisis: the zero lower bound. I need you to explain the mechanics of this. Why is zero such a brick wall?
Under normal economic conditions, if the economy slows down, the central bank lowers nominal interest rates. This makes borrowing cheaper, businesses take out loans, and the economy speeds up.
Sounds easy enough.
But during a massive systemic collapse like the GFC, the central bank cuts rates aggressively until they hit zero. And if the economy is still in free fall, they have a major problem. You cannot easily push nominal interest rates significantly below zero.
Why not? If they set the interest rate at -5%, I would just be paying the bank to hold my money.
Exactly. And rather than paying a bank a 5% penalty to hold your digital money, you and massive corporations would simply withdraw billions of dollars in physical paper cash and hoard it in physical vaults.
Oh, because paper cash has an intrinsic interest rate of 0.
Exactly. You hit a mathematical floor.
So if their primary weapon, the interest rate, is jammed at 0, what do?
Hitting the zero lower bound forced central banks into radical, unconventional monetary policies, primarily quantitative easing, or QE. Since they couldn't lower the cost of borrowing any further, they printed massive amounts of digital money and injected it directly into the financial system.
By doing what?
By purchasing trillions of dollars of long-term bonds and mortgage-backed securities off the bank's balance sheets.
They became the buyer of last resort. But beyond just buying assets, they also have to act as the lender of last resort to dying banks. The text brings up Walter Bagehot's classic 19th century doctrine on how to do this.
Yes, Bagehot's rule is the holy grail of central banking in a crisis. It states that to stop a panic, a central bank should lend freely at a penalty rate of interest against good collateral to banks that are illiquid but solvent.
Meaning the bank has genuinely good, valuable assets, but because the market is frozen, they just can't sell them fast enough today to pay off the panicked depositors. They just need a short-term cash bridge.
That is the theory. But the literature points out the supreme, almost impossible difficulty of executing this in reality.
Because it's too fast-paced.
Right. In the middle of a chaotic, fast-moving financial panic, when asset prices are crashing globally and nobody trusts anyone's accounting, how does a central banker sitting in Washington mathematically distinguish between a bank suffering a temporary liquidity shock and a bank that is actually fundamentally insolvent?
If the bank's underlying assets are truly toxic sludge, then lending them emergency cash doesn't save them. It just delays the funeral and wastes taxpayer money.
You cannot easily tell them apart in the fog of war. And this leads directly into the intense debate in the text regarding bailouts versus bail-ins.
Well, let's get into that.
During the GFC, governments executed massive taxpayer-funded bailouts like the TARP program in the U.S., injecting billions of public dollars directly into insolvent banks to prevent a total collapse of the global economy.
Okay, I have to challenge this. If the government always steps in with a taxpayer checkbook to bail out the megabanks when they fail, doesn't that permanently destroy the free market?
It certainly creates a problem.
It guarantees that banks will take wildly reckless risks. They get to keep all the massive profits during the boom years, but they know with absolute certainty that the taxpayer is the ultimate safety net during the bust.
You have just defined the ultimate moral hazard. And the academic consensus is that you are entirely correct. Bailouts create severe moral hazard.
So what's the alternative?
This is why the Handbook details a major transition in global regulatory policy post-crisis. Regulators are desperately trying to move away from taxpayer bailouts and implement a system of bail-ins.
Bail-ins. Let's walk through the mechanics of a bail-in. What actually happens to the money?
In a statutory bail-in, when a massive bank is on the verge of failure, the government does not write a check. Instead, The regulators step in and legally force the failing bank's own creditors and bondholders to take massive losses.
How so?
They forcibly convert the bank's debt into equity to recapitalize the institution from the inside out.
So the people who lent money to the bank take the haircut, not the taxpayer.
Exactly. The goal of this shift, along with the massive Basel III capital requirements, is to force harsh market discipline back onto the financial system.
To make the market police itself.
If institutional bondholders know for a fact that they will be bailed in and lose their money if the bank fails, they will theoretically monitor the bank's risk-taking much more aggressively, pricing that risk into the interest rates they charge the bank.
It is an attempt to make the free market police itself again. And speaking of market dynamics, there's a fascinating section on how regulators measure competition among these banks.
Yes, the handbook explores the econometric tools regulators use, such as the Panzer-Ross H statistic and the Lerner index.
I need a translation on those. What do those tools actually measure?
The Lerner index, for example, essentially measures a bank's markup power. It calculates the difference between the price a bank charges for a loan and its marginal cost to produce that loan. A higher index means the bank has more monopoly power in its local market.
So regulators want a low learner index. They want intense competition, right? Competition is good for the consumer because it drives down interest rates on loans.
It is good for the consumer, but the text highlights a terrifying double-edged sword for systemic stability. Intense cutthroat competition compresses a bank's profit margins.
Which means they make less money.
It destroys what is known as their franchise value, the long-term value of just staying in business safely. If a bank has low franchise value because competition is so fierce they can barely make a profit, they have very little to lose if they go bankrupt.
And if they have nothing to lose, their incentive to take wild Hail Mary risks skyrockets.
Exactly. So regulators are forced to walk a microscopic tightrope. They must promote enough competition to protect consumers from monopoly pricing, but if they allow too much competition, they destroy bank profit margins and incentivize reckless systemic risk-taking.
It is a dizzying balancing act, which brings us to the grand finale of our deep dive. We need to pull the lens back as far as possible.
The macro view.
Exactly. We are moving out of the plumbing of individual banks and looking at how these isolated failures cascade into global macroeconomic catastrophes.
We are entering the realm of macroprudential regulation and systemic risk. The text provides a vital framework for understanding this, distinguishing between horizontal systemic risk and vertical systemic risk.
Let me try to visualize this distinction. Imagine a massive table set up with intricate lines of dominoes.
Okay, I'm picturing it.
Horizontal systemic risk is contagion between the banks themselves. One bank fails, it defaults on its overnight loans to a second bank, causing the second bank to fail. The dominoes fall horizontally across the table.
That's a great visual.
But vertical systemic risk, that is the table itself collapsing onto the floor.
That is a very visceral, accurate way to understand it. Vertical systemic risk is the ultimate nightmare. It is when the financial system seizes up so severely that the contagion jumps out of the Wall Street ecosystem and violently crushes the real, physical economy Main Street.
The real world.
Right. Credit markets freeze entirely. Healthy businesses suddenly can't secure short-term loans to make their weekly payroll. Factories shut down. Mass unemployment spikes, and gross domestic product plummets.
It is the mechanism that turns a localized stock market correction into a devastating decade-long economic depression.
Yes. And the literature analyzes the history of these massive crashes in a theory they call boom and busts.
Boom and bust.
When economists study banking crises globally over the past few decades, they conclude that the most damaging, severe crises are almost never just a stroke of bad macroeconomic luck. They are consistently driven by a highly toxic specific mixture, bad banking combined with bad policies.
Meaning you have fraudulent or recklessly greedy bank management operating under a regulatory regime that is either completely asleep at the wheel or worse, explicitly encouraging the housing bubble through political mandates.
Precisely. The authors argue that without dynamic, aggressively accountable regulation and mandatory, transparent market disclosure, this cycle of boom and catastrophic bust is mathematically inevitable.
But the debate over why these panics happen goes back centuries. The text looks at historical analyses, specifically diving back into the Great Depression.
It does. The literature contrasts two major competing views of historical banking panics. The first is the panic view.
What's the panic view?
This theory argues that banks are inherently structurally fragile because of that maturity mismatch we discussed, taking liquid deposits and making illiquid loans. Therefore, healthy banks can be suddenly brought down by totally irrational, self-fulfilling herd panics by terrified depositors.
The idea that the crowd just goes crazy for no reason?
But the opposing view, the fundamentalist view, which researchers find incredibly strong historical evidence for, argues that panics are not random acts of mass hysteria.
So they have a real reason to panic.
Yes, banks fail for logical, fundamental economic reasons. Depositors line up and run on a bank because they accurately perceive, through whatever information they can gather, that the bank has suffered severe losses on its underlying loan portfolio and is genuinely insolvent.
So the people aren't acting crazy. They're acting entirely rationally to bad fundamental news. They're just trying to get their money out before the math catches up with the vault.
Precisely.
And in today's world, that fundamental bad news travels globally in milliseconds. Which brings up the final macro point in the text. Globalization.
The literature examines the intense acceleration of cross-border bank acquisitions and global integration. On paper, globalization is incredibly efficient.
It spreads out the risk.
It allows a massive bank to diversify its portfolio across multiple continents, theoretically spreading out risk. If the U.S. economy slows down, their Asian portfolio keeps them stable.
But the dark side of that integration is the contagion channels.
Exactly. It creates immediate frictionless channels for rapid contagion. Because of globalization, a toxic, fraudulent subprime mortgage originated in a swamp in Florida can be securitized, sold, and end up sitting on the balance sheet of a conservative local savings bank in a small town in Germany.
Inexplicably linking their economic fates together.
Completely linked.
Which brings us right back to the invisible, interconnected web we started this entire conversation with.
And it raises an absolutely critical question for you, the listener, to consider. After reviewing all of this, the complex theory, the misaligned CEO incentives, the regulatory arbitrage, and the massive history of panics, can systemic risk ever truly be eliminated from the human economy?
That is the multi-trillion-dollar question.
Or does it simply morph, adapt, and migrate into new, invisible forms in the shadows as our technology and regulations evolve?
So what does this all mean for you? We have been on a massive, sweeping journey through the definitive text on global finance today. We started by ripping the system down to the studs, uncovering the theoretical purpose of banks as delegated monitors, solving the frictions of human information asymmetry.
We covered a lot of ground.
We peered inside the terrifying Frankenstein-level corporate complexity of global megabanks, with their thousands of border-crossing subsidiaries and the catastrophic misalignment of paying CEOs with equity rather than inside debt. We explored a vast, rich tapestry of alternative financial models, from the relationship-driven community lenders down your street, to the profit-sharing equity models of Sharia-compliant banking, to the peer-pressure networks of village microfinance.
Right, the different species of banking.
We shined a harsh light into the $22 trillion shadow banking sector, exploring how the alchemy of securitization and tranching allowed massive risk to hide outside the safety net. And finally, we looked at the immense, crushing burden placed on central banks to manipulate interest rates, manage moral hazard, and prevent the entire vertical table of the global economy from collapsing.
And while we have spent this time dissecting high-level economic theory, agency costs, and macro-prudential frameworks, you must remember that this is not just an abstract academic exercise.
It's very real.
Very real. These invisible mechanics, the central bank rate decisions, the capital requirements, the shadow risk models, these dictate the exact interest rate you are going to pay on your home mortgage next month. They dictate the safety and yield of your retirement savings. They dictate the availability of credit that determines the overall health and stability of the industry you work in every single day.
You are inextricably woven into this web, whether you want to be or not. Which leaves me with a final lingering thought for you to chew on. In the preface of this massive academic text, the editors note the meteoric rise of fintech and decentralized finance.
The crypto wave.
Exactly. As we watch these legacy, heavily regulated banking systems clash with tech innovators, and as thousands of different cryptocurrencies promise a decentralized, trustless future free from central bank referees, we have to ask ourselves a dangerous question. Are we actually building a new, better, safer financial system that bypasses the need for this massive, clumsy regulatory architecture? Or, in our rush to innovate, are we just blindly recreating the exact same unregulated maturity mismatch $22 trillion shadow banking risks? Only this time, doing it on a blockchain. Something to think about the next time you walk past a heavy steel vault door.